Welcome to this explainer. Okay, today we are unlocking the absolute ultimate cheat code for managing your money. And listen, while our theme today might give off that classic 1920s hand-drawn animation style, those distinct rubber hose character designs, I promise you, the financial principles we're covering are completely bulletproof for the modern day. We are going to completely transform your financial mindset from that of a short-term consumer into a long-term asset producer. Because here's the real secret. Managing money, it's rarely just a math problem. Honestly, if it were, everyone with a calculator would be a millionaire.
I absolutely love this concept because it completely flips the script on what most of us think wealth actually means. It's a great reminder that finance is, at the end of the day, a massive behavioral test. It's all about controlling your habits and building structures that shield your hard-earned capital. True wealth isn't the flashy car or the crazy expensive watch. It's literally the absolute volume of options, freedom, and assets you manage to accumulate over time.
So here is our roadmap for today. We're going to level up your financial literacy in 4 quick steps: escaping the mindset trap, the math of compounding, mastering asset classes, and finally, systematic tax optimization. Let's get right to it.
Step 1. Escaping the mindset trap. This is all about tackling that daily psychological assault our brains face from modern marketing.
Think about it. Every single day, world-class marketing campaigns try to hack your brain's dopamine pathways. They are designed to make you an incredibly efficient consumer, but unfortunately a pretty terrible long-term wealth builder. So the absolute most crucial thing you can do right now is completely transition your primary identity. You have to stop being a pure consumer who views every unit of currency as just an empty voucher to go buy something. Instead, you need to become a producer investor. From now on, try to picture every single dollar as a miniature employee. Kind of like those little 2D rubber hose animated characters in hard hats just working away. You can hire them to work 24/7 to produce even more capital for you.
Let's talk about a wealth-killing phenomenon known as the hedonic treadmill, or sometimes called the raise paradox. Imagine someone named Sarah. She earns $50,000 and manages to save $2,000. Great. Then she gets this massive $25,000 raise. But instead of banking all that extra cash, her lifestyle starts to creep up. She leases a luxury car, upgrades to a premium apartment, starts eating out way more. By the end of the year, despite making significantly more money, she still only saves that same $2,000. Lifestyle creep has completely erased her wealth-building potential. She is running faster on the treadmill, but hasn't moved an inch toward financial freedom.
So why do we do this? Well, it mostly boils down to social signaling. We buy high-cost goods to project a specific socioeconomic status to everyone else. But there's a core rule you really have to remember. Looking rich and being wealthy are almost always completely opposite financial states. When someone buys a $10,000 watch that tells the exact same time as a $20 digital one, they're paying purely for social signaling. I mean, unless you're literally an international spy, you don't actually need it. And ironically, buying it just shrinks your actual underlying wealth base.
Another massive mindset trap: confusing volatility with risk. Humans are wired to feel the pain of financial loss at twice the intensity of a gain. Because of this, uneducated investors will often panic sell during totally normal market dips. They look at volatility, which is just a temporary, everyday roller coaster ride of price movements, and they treat it like risk, which is the permanent destruction of your capital. By panic selling, they take a temporary paper adjustment and lock it in as an actual permanent loss. Successful investors, though, they view those dips as standard operating tolls, not an emergency.
All right, moving on to step 2, the math of compounding. Let's see how this mindset translates into the cold, hard mathematics of the time value of money.
To really get this math, we honestly have to fight our own biology. Our brains naturally want to think linearly, right? Like stacking one brick a day. But compound interest operates on a geometric curve. So let me pose the classic penny dilemma to you. If I offered you $1 million cash upfront today, or a single magic penny that doubles in value every day for 31 days, which one would you actually take? Linear thinking screams at you to grab the immediate million. Heck, even by day 20, that doubling penny is only worth about $5,000, which would definitely make you think you'd made a huge mistake.
But just wait until day 31. If you pick the doubling penny, it explodes into over $10 million. Over $10.7 million to be exact. It's crazy, right? This perfectly showcases the absolute jaw-dropping nature of geometric growth. The exponent, which is time, holds the ultimate multiplying power.
Now, this geometric growth isn't just a fun math trick. It directly applies to your actual life, and it reveals the staggering cost of delaying your investments. Just track a 12% growth rate over time. If you save $10,000 a year for 40 years, you'll accumulate nearly $8.6 million. But if you delay starting by just 10 years, so reducing your timeline to 30 years, your final balance shrinks all the way down to $2.7 million. Think about that. That single 10-year delay costs you over $5.8 million in lost exponential growth. Time is the one asset you simply cannot buy back.
Okay, step 3. Mastering asset classes. We know the math, we know the urgency of time, so where exactly do we deploy this capital?
Think of an asset class as just a category of financial instruments. To build a robust portfolio, you really need to master 3 foundational growth buckets. First up, equities. This is buying a fractional slice of real, profit-generating global businesses. Second is fixed income, like bonds. This is where you basically act as the bank, lending to institutions in exchange for a contractual interest rate. And third, real estate, a hybrid asset offering leverage, cash flow, and physical scarcity. These are your primary economic employees. When you invest, you are literally purchasing their future productivity.
Let's actually look at why real estate is so incredibly unique. There is a real mathematical magic to real estate leverage. Imagine you buy a $100,000 property. You don't pay all cash, right? You put 20% down, which is $20,000, and the bank finances the rest. Now, if that property appreciates by just 10%, its total value grows to $110,000. You just made a $10,000 gain. But remember, you only put in $20,000 of your own cash. That means your actual return on equity is a massive 50%. Leverage allows you to multiply your returns in a way you simply cannot do easily with stocks.
But, you really shouldn't put all your eggs in one basket. Novices always try to guess the best performing asset each year, but modern portfolio theory proves that's a huge mistake. By mixing non-correlated asset classes, which basically just means they move independently of one another, you reduce your total risk without sacrificing your expected returns. When stocks crash during a recession, high-quality bonds often hold steady. Balancing stocks, bonds, and real estate creates this structural cushion. It smooths out volatility and, crucially, keeps your emotions totally stable so you don't panic sell.
And finally, step 4, systemic tax optimization. You've made the money. Now you absolutely have to protect it by deploying defensive shields against the single largest wealth leak in your financial life cycle, taxation.
Because here's the truth, paper returns are kind of an illusion. The only metric that actually matters is your net post-tax rate of return. To optimize your growth, you have to understand how modern governments categorize your cash flows into 2 very distinct silos. Ordinary income tax is applied to your active job wages, and this is highly aggressive and progressive. Capital gains tax, on the exact other hand, is applied to the profit you make when selling an appreciated asset you've held long-term. And this is taxed at substantially lower, much more preferred rates.
Now, sovereign governments actually want to incentivize you to save, so they offer these amazing legal tax shelters. You just have to pick the right one for your timeline. The 2 main types are pre-tax, which is often called traditional, and post-tax, known as Roth. With a traditional account, you deduct contributions today to lower your current tax bill, but you pay ordinary income tax on the withdrawals during retirement. With the Roth account, you bite the bullet and pay the tax upfront today. But the massive advantage is that the capital compounds completely tax-free, and your withdrawals in retirement are 100% tax-free.
So, how do you actually decide between the two? Well, it all comes down to comparing your current marginal tax bracket against your expected future bracket. Take Mark, for instance. He's a medical resident making $45,000. He is in a very low tax bracket today. Mark should heavily prioritize a Roth account, paying that low tax right now to lock in a lifetime of tax-free compounding before he becomes a high-earning physician. Now, contrast that with Jennifer. She's a peak executive making $350,000. She's in the highest tax bracket today. She should definitely use a traditional pre-tax shelter to reduce her massive current tax burden, since she'll likely be in a much lower bracket when she retires.
As we wrap up this explainer, I want you to take a second and seriously evaluate what kind of financial identity you are going to choose moving forward. Every single concept we've talked about today, from escaping the hedonic treadmill to the mind-blowing geometric explosion of compound interest to leveraging real estate and building defensive tax shields, it all comes down to your daily choices. So I'll leave you with this. Will your next paycheck be wasted on an empty voucher for social signaling? Or will it be hired as a miniature animated employee working around the clock to build your generational wealth? The choice is entirely yours.